The beginning of the year, I said the breakout asset was going to be Bitcoin. I think it looks like it's going to be the resounding inflation hedge asset for the next 50 or 100 years. So that die has been cast. I think you're seeing the last vestiges of people using gold as a rational economic insurance policy, but I think the future is specifically Bitcoin on that dimension. So I guess you could trade that, you could speculate on that.
Bitcoin is set for a massive bull run that could send it soaring past $500,000 by October 2025. That's the latest prediction out from billionaire venture capitalist Chamath Palihapitiya. Kicking off 2024, just before the SEC greenlit several spot Bitcoin ETFs, Chamath predicted that Bitcoin and Bitcoin ETFs will be the year's hottest trend. According to the venture capitalist, 2024 will be the most crucial year for Bitcoin since its inception, as it is the year that the cryptocurrency will cross the chasm into true mainstream acceptance. From this, Chamath also made his most important prediction: a massive bull run that could drive Bitcoin past the $500,000 mark by October 2025, 18 months post-halving. In a recent podcast, Chamath explains that, historically, Bitcoin's price stabilizes for the first few months after a halving event before skyrocketing around the 6-month mark. Now, he's forecasting similar conditions for 2024 and 2025. Together with fellow investors David Friedberg and David Sachs, Chamath points out that global economic uncertainty is sending more investors to safe haven assets like Bitcoin and gold. Will Bitcoin become a staple in traditional finance? Chamath is certain that it will. Make sure to stick around until the end of the video as Chamath, Friedberg, and Sachs explain the reasoning behind Bitcoin's upcoming explosive growth. Also guys, only a small percentage of my viewers are actually subscribed. If you enjoy staying up to date with finance content, consider subscribing or liking the video. It's free and you can always change your mind. Now, here's Chamath Palihapitiya with his latest outlook on Bitcoin.
There's another couple of nuances here that I think are important. The US dollar complex is thriving, which means like the US dollar is strong. Back-end yields are rising. And then another thing that I look at is this thing called put-call skew. So basically, like on balance, how are people hedging in the short term? And in the bond market, they own a lot more puts than they do calls. I think that this is the entire financial infrastructure of the world repositioning itself from what was a toss-up election to a Trump win. And when you look at why, it's because when you forget the candidates themselves for a second, but if you think about the actual policies and where the spending will occur, I think that there has been a very clear decision that the Trump economic plan will drive better growth than the Harris plan. And if you think that there is more growth coming, typically what will come with that is a little bit more inflation. The risk premium that you're going to need in a high growth environment is higher. What is risk premium? That is, how much do I want to invest for a risky asset versus a safe asset? And so all of these things are coalescing. So I think that the short-term takeaway that I have just looking at all of this data is that in the economic distribution of outcomes, this is now tilted overwhelmingly to a Trump win. And this is not an emotional statement or what I want to happen, but this is just an observation of how tens of trillions of dollars of self-interested financial actors have now repositioned their risk. And if Trump wins, which it looks like he's increasingly going to do, and if he wins by the margins that it looks like it's going to do, you're going to see a lot of these things exacerbate. Gold's going to go up more, probably. Bitcoin will probably go up. The short-term economic upside for the economy will probably get reflected in higher equity prices, but it'll also push out long-term rates. The inflation picture becomes a little bit murkier. But I think that that's what's happening. I think that the financial markets are pricing in a Trump win.
Sorry, just to understand better, why does gold go up in a Trump win?
I think in the short term, what happens is that you see more economic growth, but in the medium term, inflation goes up, and so you want to hedge.
Right.
So it's more about a durational balance of assets. So in the short term, you'll be long the things that will generate earnings, but in the medium to long term, you want to hedge yourself. So Bitcoin and gold, I think, will trade that way.
The key line that Paul Tudor Jones said was all roads lead to inflation. I mean, that's what's basically happening right now, is that the market is afraid that inflation is not whipped and is going to resurface, and the Fed may have to pivot from the pivot and raise interest rates. That's why he doesn't want to own any treasuries. Separately, another financial legend, Stan Druckenmiller, gave an interview where he has something like a 20% short position, meaning 20% of his holdings are short U.S. treasuries right now. So he's betting that there are long-term inflation pressures and that rates are going to have to rise. And you're seeing, again, that since the Fed cut rates on September 18th by 50 basis points, that the 10-year T-bills yield has risen by 60 basis points. So I think my interpretation is that this is less about the election and more about the markets not liking the Fed's rate cut on September 18th. I think that in hindsight, it was too big.
David Sachs sees the Federal Reserve's 50 basis point rate cut in September as a clear signal that the US economy is in trouble, despite Chair Jerome Powell's reassurances. This cut kicks off a rate-cutting cycle the Fed has only initiated 3 times before, in 2001, during the 2008 financial crisis, and amid the COVID-19 pandemic, all leading to severe economic downturns. According to Sachs, the Fed's choice to start with a 50 basis point cut, rather than the expected quarter-point reduction, indicates a state of panic among officials. They're scrambling to maintain calm and prevent the economy from collapsing. With that, Sachs and Friedberg suggest that the recent performance of safe haven assets like gold and Bitcoin supports these concerns and foreshadows challenges ahead for the US and global economy in 2025. Now, back to the discussion.
So again, the market is concerned that inflation is not whipped, that the Fed may have been overly precipitous in how it cut rates. And then the other thing is they just do not like the long-term fiscal picture of the US. One other chart we should bring up is interest on the national debt. What you can see here is that it has gone absolutely parabolic in the last couple of years. Our interest on the debt is something like 1.3, 1.4 trillion a year.
1.35 trillion run rate. Yep.
Yeah.
$3,500 per American. Per year.
And it's something like 20 to 25% of federal revenue now is going to debt service. And this continues to increase. Now, I think there was an expectation that we'd be able to get this line to go back down once we had rate cuts, right? Because if inflation's licked and the Fed can lower interest rates again, and we can get back to a 2% 10-year bond, which is where we were a few years ago, then all of a sudden that national debt service becomes a little bit more reasonable, right? I mean, you could service that debt at half the cost. But now it looks like that may not happen. So just to wrap this up, I just think that the market doesn't like these fundamentals of the U.S. fiscal picture. You've got rapidly increasing debt service costs. You've got an inflation picture that is murky and may not be going away. And the bond markets are starting to price in higher interest rates for longer. And this is why Paul Tudor Jones is saying all roads lead to inflation. And this is why Druckenmiller is shorting U.S. treasuries.
So just to give you guys a sense, total U.S. household, corporate, and government debt, which includes state and local and federal. So household debt in the U.S. about 18 trillion. Corporate debt's about 11 trillion. State and local government debt's 3 trillion. Obviously, the federal debt, 36 trillion. That adds up to a whopping $68 trillion of total debt across the U.S., which if you assume a 6% average interest rate, you got corporate debt and household debt, so it's a little more risky, so it carries a higher rate. That means we're spending about $4 trillion a year of an economy that's only $29 trillion a year to service the debt, just to pay the interest on the debt. So 15% of every dollar that trades hands is going towards interest payments on existing leverage, on existing debt. It's a highly leveraged system. And if you look around the world, this problem is not just a US challenge. Global leverage is a problem that's now becoming a crisis for countries everywhere. So this is becoming kind of a global leverage problem, which might explain the flight to safety in assets like gold and Bitcoin, and is going to present a lot of real struggles for every global economy. Now, the question is, does the US dollar maintain its reserve status? Because ultimately, I think it is inevitable that the Federal Reserve in the United States is going to need to buy the debt. They're going to need to monetize the debt, which means printing money. There is no one else to buy the debt. So pull up the China chart, Nick. China's historically been the biggest buyer and owner of US Treasuries, but here's what's happened in the last couple of years. It peaked at about $1.3 trillion about 10 years ago, and then recently, particularly starting around COVID, they began selling down and have been selling down at an accelerated pace. Today, China is back to the level they were at nearly 15 years ago in terms of their treasury holdings, and they have publicly declared that they are selling off US Treasuries and buying gold instead. So the biggest buyer of US Treasuries has kind of left the market or is leaving the market. Who does that leave? Well, at the end of the day, the Federal Reserve has been the kind of buyer of last resort. And if they end up buying treasuries, that's where we have a problem with too many dollars and inflation kicking up. And so it feels like a lot of the trades in assets are what's going to benefit from the inflation. And it's going to be gold, it's going to be Bitcoin.
Meanwhile, the International Monetary Fund has issued a serious warning about the global public debt crisis, predicting it will exceed $100 trillion by year-end, with the US and China being major contributors. The IMF's report states that public debt could reach 100% of world GDP by the end of the decade, a situation that could have severe consequences. Vitor Gaspar, the IMF's Director of Fiscal Affairs, noted that public debt might be worse than it seems due to government optimism in their calculations. Many governments are increasing spending for growth and security while resisting higher taxes, leading to less sustainable debt levels. Sub-Saharan African countries are particularly pressured, needing to spend to combat poverty while struggling with limited tax revenues. The IMF warned that unsustainable debt levels could trigger a sudden sell-off in global financial markets, increasing demand for safe haven assets like gold and Bitcoin. What do you think about all of this? Let us know in the comments. Anyway, guys, before we go, if you want to stay most up to date on the crypto and Bitcoin world, make sure to subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top-on-chain analysis, trusted by over 50,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it provided you with some value. I'll see you all in the next one, and as always, all the best.